Most people enter day trading believing the hardest part is finding the right strategy. But after years in the market, I realized something surprising. Strategy was never the real problem. The real problem was the mistakes I didn't even know I was making, mistakes that quietly destroy accounts, confidence, and years of progress. If someone had told me these 7 things before I started day trading, it would have saved me an incredible amount of time and a lot of money. I started day trading with the same belief that almost every beginner has. I thought the entire game was about finding the right strategy, the perfect setup, the perfect indicator, the perfect entry signal. I believed that somewhere out there was a strategy that would finally make everything click. A strategy that would remove uncertainty and turn trading into something predictable. So I spent countless hours searching. I watched videos, read forums, tested indicators, and studied charts late into the night. Every time I discovered something new, I felt a small wave of excitement. I would think, this is it. This is the one. But the market has a way of exposing reality very quickly. The first few trades with any new strategy often looked promising. A couple of winning trades would appear, confidence would rise, and it felt like progress was finally happening. Then something strange would occur. A losing streak would begin. At first, it didn't seem like a big deal. Losses are part of trading, after all. But after a few more losses, frustration started to appear. Suddenly, I would begin questioning everything. Maybe the strategy was wrong. Maybe the market had changed. Maybe I needed something better. So I would abandon the strategy and begin the search again. A new indicator, a new system, a new approach, and the cycle would repeat. This pattern is incredibly common among new traders. In fact, it is one of the most expensive habits a trader can develop. The constant search for the perfect strategy creates the illusion of progress, but in reality it keeps traders stuck in the same place. Because the strategy was never the real problem. The real problem was execution. Execution is where most traders quietly sabotage themselves. It is the difference between what a strategy says you should do and what you actually do in the moment. And those two things are rarely the same. For example, a strategy may say that a trade should only be taken when certain conditions appear. The rules might be clear and simple, but when you sit in front of the chart and watch price moving, emotions start to influence your decisions. You begin to anticipate signals instead of waiting for them. You convince yourself that a setup is close enough. You enter trades early because you are afraid of missing the move. And suddenly you are no longer following the strategy. You are following your emotions. This is where most traders lose money, and they don't even realize it. They believe the strategy failed. But in reality, the strategy was never truly followed. Another common mistake appears after a losing trade. A strategy might require patience after a loss. It might require waiting for the next valid setup. But after losing money, something changes psychologically. You want the loss back. You want to fix the mistake immediately. So instead of waiting, you take the next trade you see, and then another one, and another one. This behavior is known as revenge trading, and it destroys accounts faster than almost anything else. But again, the strategy was not the problem. The problem was discipline. The market does not reward knowledge alone. Many traders understand charts very well. They know patterns, indicators, and technical analysis concepts. But knowledge without discipline is powerless. The professional trader understands that a strategy is simply a framework. It is a set of probabilities, not a guarantee. Some trades will win, some trades will lose. The outcome of any single trade is uncertain. The goal of the strategy is not to predict every move correctly. The goal is to create an edge over a large series of trades, but that edge only exists if the rules are followed consistently. If a trader changes the rules based on emotion, the edge disappears. And once the edge disappears, the strategy becomes meaningless. This is why professional traders spend far less time searching for strategies than beginners do. Instead, they focus on execution. They focus on building habits. They focus on following their rules even when it feels uncomfortable, because trading often requires doing the opposite of what emotions suggest. When a trader feels excited, it might be the worst time to enter. When a trader feels afraid, it might be the best time to stay patient. Emotions are powerful, and they constantly push traders toward impulsive decisions. That is why discipline becomes the real skill. Discipline means entering only when the setup is valid. Discipline means accepting losses without trying to recover immediately. Discipline means following risk management rules even after several winning trades. These behaviors sound simple, but in practice they are extremely difficult, because the market constantly tests your ability to stay consistent. Some days the market moves slowly and creates boredom. Other days it moves quickly and creates excitement. Both environments can lead to mistakes. Boredom can lead to overtrading. Excitement can lead to impulsive entries. The disciplined trader recognizes these emotional traps and avoids them. Instead of trying to trade constantly, he waits for the right conditions. Instead of chasing every opportunity, he focuses only on high probability setups. And over time, something interesting happens. Trading becomes quieter. There are fewer trades, but the quality of those trades improves. Losses become controlled. Profits become more consistent. And the account begins to stabilize. This transformation does not come from discovering a magical strategy. It comes from mastering execution, from learning to follow a plan, from understanding that success in trading is not about being right all the time. It is about being consistent over time. Looking back now, this is one of the first lessons I wish someone had explained clearly before I started day trading. The strategy was never the biggest challenge. The real challenge was learning how to execute that strategy without letting emotions take control. Once a trader understands this, everything begins to change, because instead of searching endlessly for something new, the focus shifts toward improving discipline. And that shift is where real progress begins. One of the most expensive lessons I learned in day trading was about risk management. When most people start trading, they focus almost entirely on profit. The first question they ask before entering a trade is always the same. How much money can I make from this? It feels natural to think this way. After all, the reason most people enter trading is to make money. But this mindset quietly creates one of the biggest problems for beginners. They focus on reward before understanding risk. In reality, professional traders think in the opposite direction. Before they ever consider how much they might earn from a trade, they ask a much more important question. How much could I lose? This small shift in thinking changes everything. When beginners enter a trade, they often choose their position size based on confidence. If the setup looks strong, they increase their size. If they feel uncertain, they reduce it. The problem is that confidence has very little to do with what the market will actually do. The market does not reward confidence, it rewards discipline. Without proper risk management, even a few bad trades can damage an account significantly. Imagine risking a large percentage of your account on a single trade. If that trade fails, the loss immediately creates emotional pressure. Now, every future decision becomes influenced by the need to recover that loss. This is where many traders begin making even bigger mistakes. They increase position size to win back money faster. They abandon their strategy because they feel frustrated. They begin entering trades impulsively, instead of waiting for proper setups. This cycle can destroy months of progress in a very short time. Professional traders avoid this situation by rolling risk before the trade even begins. They understand that losses are not just possible, they are guaranteed. No strategy wins all the time. Because of this, they structure their trades in a way that protects their capital. A common rule used by disciplined traders is risking only a small percentage of their account on each trade. This approach may seem slow at first, but it has a powerful advantage. It allows the trader to survive losing streaks without emotional damage. And survival in trading is extremely important. The longer a trader stays in the market, the more experience they gained. The more experience they gained, the better their decision-making becomes. But traders who ignore risk management rarely stay in the market long enough to develop that experience. Another important benefit of proper risk management is psychological stability. When a trader knows that a single loss will not damage their account significantly, they remain calm, they can think clearly, and follow their plan without panic. This emotional stability leads to better decisions. Over time, something interesting happens. Instead of constantly worrying about individual trades, the trader begins focusing on long-term consistency. They understand that trading is not about winning every trade. It is about executing a strategy repeatedly while controlling risk. Looking back, this is one of the most important lessons I wish someone had explained before I started day trading. Profit is important, but protecting capital is far more important. Because in trading, the traders who survive the longest are the ones who eventually become profitable. Another lesson I wish I had understood earlier in day trading is the real value of patience. When most people enter the world of trading, they imagine a fast-paced environment where opportunities appear constantly. They believe successful traders are always I've always entering trades, always reacting quickly to every movement in the market. This belief creates one of the most dangerous habits in trading: overtrading. Overtrading happens when a trader takes too many trades, simply because the market is open. Instead of waiting for high-quality opportunities, they begin trading every small movement they see. At first, this behavior may feel productive. After all, being active feels like progress. When you are placing trades and watching the market closely, it feels like you are working toward success. But trading does not reward activity. It rewards discipline. The market offers thousands of price movements every day, but not all of them are worth trading. In fact, most movements are random noise. They have no clear structure, no strong momentum, and no reliable direction. Professional traders understand this. Instead of trying to capture every movement, they focus only on the moments when the market provides a clear advantage. These moments are rare, but when they appear, they offer much higher probability. This is where patience becomes a powerful skill. The disciplined trader spends much more time waiting than trading. They observe the market carefully, studying the structure, watching how price reacts to key levels, and waiting for confirmation before making a decision. For beginners, this waiting period can feel uncomfortable. Watching the market move without participating often creates anxiety. A trader may begin thinking that they are missing opportunities. They see a move happening and feel the urge to jump in quickly before it continues. This emotion is known as the fear of missing out. Fear of missing out causes traders to abandon their plans. Instead of waiting for a clear setup, they chase the market. They enter trades after the move has already started, hoping that the momentum will continue. But markets rarely, you move in straight lines. After a strong move, the market often pauses or pulls back. Traders who enter late suddenly find themselves in a losing position, even though the overall direction of the market might still be correct. This situation creates frustration. The trader begins questioning their analysis, even though the real issue was timing. Professional traders avoid this problem by developing patience. They understand that missing a trade is not a failure. The market will always provide new opportunities in the future. Capital, however, is limited. Every unnecessary trade increases the risk of losing money. That is why experienced traders treat patience as a form of risk management. They wait for confirmation. They wait for strong setups. They wait for conditions where the potential reward clearly outweighs the risk. This selective approach dramatically reduces the number of trades they take, but it increases the quality of those trades. Another important reason patience is valuable is emotional control. Trading constantly creates mental fatigue. When traders place too many trades in a short period of time, their decision-making begins to deteriorate. They become impulsive, careless, and less disciplined. By trading less frequently, professional traders protect their focus and clarity. They remain calm, they remain objective, and when the right opportunity appears, they are mentally prepared to act. Patience also changes how traders view time. Beginners often measure success on a daily basis. If they finish the day without making money, they feel disappointed. This pressure pushes them to force trades that should never have been taken. Experienced traders think differently. They measure success over weeks, months, and even years. Their goal is not to make money every single day. Their goal is to follow their strategy consistently over a long period of time. Because consistency, not excitement, is what creates long-term profitability. When a trader truly understands this concept, their behavior begins to change. They stop chasing the market. They stop feeling pressure to trade constantly. Instead, they begin focusing on preparation and observation. They study their charts. They review their previous trades. They analyze market conditions carefully before entering a position. And when the right moment appears, they execute their trade calmly and confidently. Looking back now, Patience is one of the most important skills I wish I had developed earlier in my trading journey. If someone had explained this clearly when I first started day trading, it would have saved me countless mistakes. Because the truth is simple, the market does not reward the fastest trader, it rewards the most disciplined one, and discipline begins with patience. The final lesson I wish I had understood before starting day trading is about consistency. When most people enter trading, they imagine success as a series of big wins. They picture catching massive moves, doubling accounts quickly, and making large profits in short periods of time. This idea is very attractive, but it is also very misleading. Real trading success rarely comes from big dramatic wins. Instead, it comes from small, disciplined decisions repeated over a long period of time. Consistency is the foundation of professional trading. Beginners often approach trading with a very different mindset. They want immediate results. They want to prove to themselves that they can make money quickly. Because of this, they take unnecessary risks, increase their position size too early, and chase opportunities that do not fit their strategy. At first, this approach may produce a few exciting wins, but excitement is not the same as stability. The same risk-taking behavior that produces a big win can also produce a devastating loss. When losses occur after aggressive trading, the emotional impact becomes much stronger. Traders begin to feel frustration, doubt, and pressure to recover their money quickly. This emotional pressure leads to more mistakes. Instead of slowing down and returning to their plan, many traders increase their risk even further. They believe a larger trade will help them recover faster. Unfortunately, this approach often leads to even larger losses. Professional traders think differently. They understand that trading is not about proving something in a single day. It is about building a stable process that works over hundreds of trades. A professional trader does not measure success by one trade or even one day. They measure success by how consistently they follow their rules. Did they wait for the correct setup? Did they manage risk properly? Did they control their emotions during the trade? If the answer to those questions is yes, the trade was successful even if it resulted in a small loss. This mindset may sound unusual at first, but it is extremely powerful. When traders begin focusing on execution instead of outcomes, their performance becomes more stable. They stop reacting emotionally to short-term results and start evaluating their behavior over a longer period of time. Over time, consistent behavior produces consistent results. Losses become smaller and more controlled. Profits become more structured. The equity curve begins to move upward gradually rather than jumping unpredictably. This type of growth may appear slow, but it is far more sustainable. Another important aspect of consistency is routine. Professional traders often follow very structured routines before and after the market session. They review charts, analyze previous trades, and prepare mentally for the trading day. These routines help them stay focused and disciplined. Without a routine, trading decisions become random. Traders begin reacting emotionally to every price movement, which leads to impulsive behavior. Routine creates stability. Stability creates discipline, and discipline creates consistency. Looking back at my own trading journey, this is one of the lessons I wish I had understood from the beginning. Success in trading is not about extraordinary moments. It is about ordinary discipline repeated over time. The traders who survive and eventually succeed are not always the smartest or the fastest. They are the ones who remain patient, manage risk carefully, and follow their rules even when it feels uncomfortable. In other words, they are consistent. If someone had explained this clearly before I began day trading, it would have changed the way I approached the market from the very start. Because once you understand the value of consistency, trading stops feeling like a gamble. It becomes a process. And that process is what ultimately leads to long-term success.